As I mentioned in the previous episode, digital banking is a modern way of banking online and via mobile banking. It allows users to access banking services such as bill payment, account management, and more via digital platforms like mobile app or via a bank's website. Digital banking is central to many people's daily banking activities today, but it didn't just develop overnight. We can actually trace it back to between the 1960s and the 1980s, when banks started to use mainframe computers to automate tasks when processing payments and managing customer accounts. From the 1990s to 2000s, the power of the internet was harnessed with the introduction of online banking services. Since the 2000s, the popularity of smartphones has led to the advent of mobile banking, allowing customers to bank on the go. Looking ahead, we are starting to experience a new evolution of digital banking with new technologies such as blockchains, AI, and machine learning that enhance customer experience and security. It is clear that digital banking has seen continuous innovation and adaptation, driven by technological advancements as well as changing customer expectations. So, how does digital banking actually work? Firstly, look at how we are actually able to send and receive money via the internet. We have application program interface or APIs. They enable third-party developers to access banking data and services, facilitating features like mobile banking apps, payment processing, and financial management tools. Then, we also have peer-to-peer payments. These are essentially technologies that allow direct payments between individuals through mobile payment apps. These convenient transactions also need to be made secure so that they can't be intercepted or made fraudulently by people with bad intentions. This is where we have technologies like blockchain, which offers a secure and transparent way to conduct transactions to reduce fraud and improve trust in digital banking. It's like having a shared digital record of transactions across multiple computers. This decentralized system ensures transparency, security, and permanence of data, allowing for faster and more secure transactions without the need for third parties. Additionally, we have technologies that verify it's really you making transactions, like two-factor authentication. AI and machine learning are also essential for digital banking services, as they can be used for fraud detection. However, it's also essential for making customer experiences even easier and more convenient. AI and machine learning create personalized banking experiences, provide efficient customer services through chatbots, and much more. Finally, digital banking is made even more convenient by the Internet of Things, or IoT. This offers new ways to interact with banking services, such as through smartwatches and home assistants. Digital banking has had far-reaching positive impacts. Firstly, it puts customers first. Digital banking has shifted the focus of banks towards a customer-centric model. Banks now mostly tailor their services to meet individual needs and preferences. Digital banking platforms have also made banking services more accessible, particularly for unbanked and underbanked populations. This helps reduce economic inequality. Additionally, it has encouraged innovation in products and services, leading banks to offer a broader range of products and services that are more usable and cost-effective customer experiences. What about issues and concerns? Despite its benefits, digital banking has also presented some issues and concerns that must be managed to make it even safer and more effective. Firstly, digital banking has forced traditional banks to restructure their operations to adapt to the digital age. Hitherto, individuals, systems, processes, or departments within traditional banks often operate in isolation from others. There have also been plenty of security challenges, as banks now have greater responsibilities for protecting customer data and preventing fraud online. Finally, the automation of services has impacted the workforce, with some jobs within traditional banking phased out, like people in charge of data entry or processing paper checks, and new roles created that require digital skills. Regulation plays a crucial role in digital banking, ensuring the stability and integrity of financial services whilst fostering innovation and protecting customers. Digital banking has required regulators to adapt and create new frameworks to oversee the evolving landscape of financial services relating to the following areas. Risk management. Digital banks are subject to regulations that focus on credit, the risk posed by the parties involved, whether someone has the capital required for a particular banking service, and compliance, or similar to traditional banks. Consumer protection. Regulations ensure that digital banks maintain high customer data protection and privacy standards, and provide clear information about products and services. Anti-money laundering. Digital banks must comply with AML regulations, including Know Your Customers or KYC, and transaction monitoring requirements. Licensing. Regulators may issue specific licenses for digital banks, including requirements for capital held by the digital bank, their risk management protocols, and the resilience of their operations. Operational continuity. Regulations require that digital banks have robust systems to ensure consistency in their operations and handle technological or cyber risks. So, you have learned all about digital banking. In the next episode, we will be taking a deep dive into globalization and its impacts on modern banking and finance.